Welcome to a community built of tomorrow's business leaders. Hey guys, I'm Julian Fayad, and this is the Socius Podcast. Socius, welcome back to another episode. Today we've got Julian Fayad from Loan Options. Julian, welcome to the show.
Thank you very much for having me.
Now, you're someone that I've relatively stayed in touch with to some degree. We've caught up with some networking events, but you're someone that I have seen and respected from a distance, to be honest. I've seen the business that you've built, and many that might be listening to this show know a little bit about Loan Options. Those that don't, Julian will give us a little bit of a background, but I'm really keen to get a little bit of an understanding into your background, how Loan Options became to be, without giving too much. It's an asset finance brokerage, you would probably say, or an asset finance business. But how you differentiate in an industry that is fairly standard, you could say, is something that we want to touch on today. So, Julian, welcome. Tell us a little bit about your background and what had you been to where you are today.
Yeah, so I was always a bit of a nerd growing up. Always noticed that I was just, maybe just sort of outside of, I was always really good at sport and all those normal sort of teenager sort of things growing up, played rugby league, but I always had this really nerdy, quirky side and really enjoyed working on problem solving and learning different things. I would read forums about topics I was interested in, cars and engines, and read a ton of books where other kids that was probably not standard. And so when I left school, I wanted to study web and app development, and that's what I did. I was studying full time, and after that, I accidentally fell into finance, and that's kind of a different story. But I fell into finance and started working full time along with my full time study, and over a while that became really tricky. Really early starts, really late finishes. No social life at all. It was full on. So eventually I took the decision to just pause my official studies. I didn't stop learning. I always, did things in my own time, and I was self-taught in a lot of areas, but I went down the career of being a finance broker. So I started as a junior, worked my way up through that career, and, eventually ran fairly large teams, 23, 24 people, and, eventually got an opportunity to be a minority shareholder in another business. So I went to help set that up and had a lot of success in that business. And, then COVID happened, and that was kind of the catalyst for me starting LoanOptions.ai. And, before I started Loan Options, I was effectively building in my own time the concept or the MVP for what is now Loan Options. And, I started building that in 2017 before launching in 2020 as a standalone business. But in all those businesses that I worked in and was a shareholder in, I always built the tools and technology for those companies, all the reporting, all the automations, sales process. It was just something I really always cared about. And that was like a passion for me. That was fun. And so, when I started Loan Options, invested a significant amount of money in AI back in 2020, before people knew really what AI was. And there's a whole range of reasons why I did that, but ultimately I always research emerging technologies. And if you ask me now, like, what are technologies to watch? Like, obviously you've got, outside of AI, I'm talking about, quantum computing and other verticals like that I think are very, very interesting and are going to change the way that we do things in the world. So, that's essentially the sort of shortest version of how I got started. I was a nerdy kid, loved computers, loved tech, started building stuff that would solve problems. Like when I was 19, I built and deployed an app on the Apple App Store, just self-taught.
What was it?
It was like a aggregated sports news app. It was just something that me and my mates would like, so I built it for myself and wanted to go through that learning process. And eventually got it to about $2,000 or $3,000 a month in ad revenue, and then eventually like Flipboard and these other companies came out and they were just so much better. I was just like, on to the next. But it was really cool to sort of go through that and learn that and have that box ticked. And now we have a team. I do have a technical background and I have some technical knowledge, but our CTO and the relevant engineers in our team are 10x smarter than me. So I just leave it to them. But, I certainly am the ideas guy or the problem solving guy. As far as the actual writing of the code, I don't do much of that at all these days. I'll build the occasional calculator or something like that.
Yeah. So what was it about finance that drew you away from your studies? Because naturally, that seemed to be your passion. Web development, app development, and there was something that you really, realized it sparked an interest for you. So what was it about finance? Because obviously, late nights, early mornings, and the like, big hours. But what was it specifically?
I loved cars, and so that was, something that I always loved growing up, and that the opportunity was specifically starting in car finance. So I was like, oh, amazing, I'm going to get to learn and finance all these cars. And so that was one of the reasons. Also, like I did in high school, I took an information technology course, and also I did maths as well. But, there wasn't a big discrepancy in terms of my skill level in maths or IT. I got 92 in IT and then 88 in maths. So I was pretty good at maths, and finance was probably a backup career anyway. It wasn't something that I was really focused on. I wanted to be a police officer and wanted to be in tech, and like further down the list was finance. So it wasn't totally out of the realm of possibility, but an opportunity came up, and you could earn a really good living in the finance industry. You did have to work really hard, and between the age of 18 and 23, I had one weekend off. Worked every other weekend. All my mates were out partying and stuff like that, but I put in the effort and set myself up pretty well. Bought my first property when I was 22 years old, and got married, and started my own life at a pretty young age. So.
Did all the things that most people waited to do were mid-30s.
Yeah, exactly. Exactly.
And so, I guess, what was it specifically that made loan options different? What had you want to drive that differently? Give us an insight into that.
Yeah, so the traditional process for applying for a loan and going through a broker, right, or through the dealership, we can use that as well because they've got their own problems, was not very transparent. It left the customer out of the loop. You were subject to, whether the broker was a good communicator or not, and what panel of lenders did they have access to, and were you eligible for any of the loan products? There was a whole range of questions, and you would ask for a quote, and they'd say, okay, well, I need to do the application first and then understand a bit more about your situation, and then I'll come back to you. So in a lot of situations, that doesn't give the client a whole lot of comfort that they're being dealt with in a transparent manner. So initially, when I started building it, it was about getting to the decision or getting to the lending options that are relevant for that customer's individual circumstances as fast as possible. And first, it was a tool that the brokers could use to come to that conclusion, and then give a report to the client and say, here are your options, and do that within minutes instead of hours or days or weeks in some circumstances. And over time, we kept moving that process more, like made it faster, moved it more and more close to the customer's interactions, to the point where it was now, if the client was on our website, and this is what they can do now, they can go on our website and they can see the relevant loan options within about 30 seconds. And then the more information they input, the more accurate those results get. And it can be across a whole range of products, cars, equipment, unsecured business loans, unsecured personal loans, if they want to go on a holiday or do some renovations around the house. They'll actually see the loan options that are relevant for them. And instead of filling out a long, boring application form, which is another downside of applying for a loan and all the information and documents you have to provide, we made the process so simple that all they have to do is upload their ID, connect their bank account, and upload a payslip. And if they're self-employed, obviously they don't do that last step. They just put in their ABN business name, and we use third-party registers to pre-fill their business details. But when they upload the ID, all of their personal information is pre-filled. We scan it. It goes into our autocomplete contextual AI engine. We extract all the data from the ID, verify quite a few details, and then pre-fill the information. Same thing with the bank statements. All of their income and expenses is pre-filled for them. Save them having to get financials or other, expense statements, etc. And then the third one is the payslip if they're a PAYG employee. And we, again, read the information on the payslip, calculate the income, make sure it all stacks up, check if flag if there's overtime or bonuses or anything that needs to somebody to have a closer look, and pre-fill that information for them. We run a soft check on the credit file. That was the other problem with the traditional finance model. If you wanted to apply through a bank, they would instantly put a credit inquiry on your credit profile, your credit file, and that would lower your score. And so if you do that 3 or 4 times to try and get a good deal, you actually lower your score to the point where you're costing yourself thousands of dollars in extra interest because your score is now lower. Our process doesn't put any inquiry on the client's file, and they can compare up to 90 banks and lenders simultaneously. And so that's a great value add for the client. Compare, the real options that they qualify for, and apply in less than 5 minutes.
And so that's obviously a really good unpacking of how, I guess, the technology works to simplify the customer journey. But I work in the insurance space, which is almost archaic as banks, or probably a little bit more archaic. But I mean, a lot of this technology, how much of this already speaks to banks, or at the start, were there any APIs that linked in with banks? How were you providing a rough summary of what the loan options were for these people?
So some of them have APIs, but very few of them, to be honest. The way we actually do it is we invested a lot of time, energy, money, and resources into building, and this was the original concept for what Loan Options was, a loan matching and credit decisioning engine. So we would get, as an accredited broker, a copy of the lender's credit policies, and our team of policy analysts, and initially it was me doing this, would actually read and interpret the policies, write it into logic and rules, and then the client's information would be cross-checked against each lender. So, we got to learn their policies really well, and the tricky part is they have a credit policy, but then they also have another thing which we call credit appetite. Because it's one thing to say that you like certain types of borrowers, it's another thing to, whether or not you actually say yes to them, right? Because sometimes they just change their credit policy to make sure that if you're just looking at it at face value, they're competitive with their main competitor. Yeah. Could be a big 4 bank, changing their policy to look like they can compete with the other big 4 bank. But the reality is they say no a lot more than they say yes to that type of client. Yeah. So we had to interpret all of that, and we had thousands and thousands of scenarios that, it took us a while to reverse engineer that, years from 2017 to 2020. And, but that sort of slow burn, delayed gratification is really good for us, because I guess that's our, one of our many moats. It's, as a business, what we do is very, very hard to replicate, and you require a lot of resources to build that decisioning engine, but then also reverse engineer and maintain all of those lender policies, because of course they change so frequently as well. So that's essentially what we did.
So what sort of challenges did you face? Because as you just said just then, these policies can change all the time, right? Was there ever instances where you're like, yeah, the decision-making engine is saying that we can absolutely get some terms here for a client, and then it comes back, you actually put in, I presume you still need to do the application at some point once the client's like, yeah, that's the option I want to go ahead with, and then the bank comes back and says, actually, no, we've changed our appetite. Were there ever instances like that?
Yeah, quite a few, and I'll talk you through them. So one was, some lenders have a really long memory, right? And so I'll give you an example. There's a lender that provides store cards at Harvey Norman, and if somebody had a store card, and they to their credit, they fixed this as an issue, but it was Latitude, they're one of our lenders. They used to keep track of clients who had maybe a store card from 7 years ago or 10 years ago, and so this information of poor repayment history isn't on their credit file anymore. But in their database, they actually have like a do not lend sort of black mark against the client's name. So it's almost impossible, and anyone who's suggesting that you can have 100% level accuracy on the type of tool that we build is misleading you. But you can get close, right? And there's always going to be those edge cases where the client applies for a loan, everything looks great, it meets the criteria of that particular lender, but 7 years ago, there was something that happened with that lender, and obviously you can't see that because they don't share their database and records with you for obvious reasons. So that was one example. Another one was when the lenders, so our credit decisioning engine is made up of 4 components. The first module or component is credit policy and pricing. The second one is serviceability/affordability. The third one is bank statement conduct, because of course, these days if you have lots of sports bet or $300 cash withdrawals at pubs. Like lenders can see that, and they're not stupid. If it's like, you Saturday night, you're withdrawing $300 from a pub ATM, you're doing one of two things: either putting that money in the pokies, or they
know exactly what's happening,
or the other thing, right? And we can credit decision based on those bank statement conduct rules. And then the last one is where the name of our business comes from. And this is our flagship AI model. This is a proprietary model that we built. It's a machine learning model that predicts the probability of approval with each lender. So the credit rules are fantastic for black and white stuff. Credit score needs to be above X, employment history needs to be Y, age of the credit file, and other things, metrics need to be Z. What credit rules are not good for is capturing gray area based on historical data points, and that's where AI really shines. So AI is really good at the gray area, and so we can feed it hundreds of thousands of rows of data, and it can look at previous historical applications and see where they ended up being successful in settling. So now we have a probability of approval model that looks at the client's current scenario, cross-references it against de-identified versions of similar scenarios, and says, based on all of these data points, these three lenders will say yes. But then how do you differentiate between which of the three lenders to pick, assuming that pricing is all the same? Well, one of the reasons you can differentiate is who is most likely to actually say yes, like actually approve it, and historically speaking, very likely to say yes. So it could be of the three lenders, one has a 96% chance of approval, and the two others have 70 and 30% chance of approval. Well, that's a no-brainer, right? Assuming they all have the same pricing, I'm going to pick the one with the highest approval. And so that helps. But that one of the things that became a difficulty is when lenders did change their policy, and I'm not talking about tweaking, I'm talking about wholesale changes to their credit policy. It took a while because we were initially hoping that the AI could do it all. And we probably in the early days overestimated AI's capability, and probably thought it was going to be more intelligent more quickly, believe it or not. We've only really started to see, through LLMs, that AI is now mainstream, and people are starting to talk about, when do they become super intelligent and sentient and all this kind of stuff. But I think there's still a number of years before that happens. But so one of the lenders changed their policy. They used to accept a minimum amount of casual employment of 9 months, and then they changed it to 4 months. And so it wasn't recommending this lender, even though we changed the credit rules. Every time we had a scenario that we should pick that lender, we detected it wasn't. And so what would happen is, it wouldn't come up, and it would say that it's basically a 0% chance of approval. Yeah. And so, that was the point where we said, okay, well, we think for the foreseeable future, we're going to need this hybrid model where we use both credit rules and AI, not just one or the other. And so that was another example. They changed their policy significant enough where there's no historical data to support that decision, and we have to let the human intervene and find that right lender for the customer so they don't miss out. And
so my assumption is the model gets closer to 100% accuracy, or as accurate as it can be with the more leads or more opportunities that go through it, right?
Yeah, that is. It's a number. The amount of data that you have is basically a key component there. The amount of similar scenarios that you have in your database. One of the other problems that we had was we had some lenders that would get lots and lots of volume because their product was really great and all that kind of stuff, and then some lenders that were fringe or private lending or non-conforming lending, and there just wasn't enough data for those lenders to support a fairly accurate model. The credit rules are really important in that scenario, and then just over time, just giving it repetitions. Setting up reinforcement learning and things like that for the models has also been really important for us, so we can continuously teach and retrain those things. But that was a moment where we had to look at how to downsample certain lenders that had lots of records, too many records, and then upsample some that didn't. So basically create synthetic data to support. Yeah.
And interestingly, you said that a few of the banks were happy to provide the credit policies with you. Is that something that's standard across all banks, or is that only particular banks that decide to partner with you?
No, they're all in Australia. It's a bit more tricky in New Zealand because we've obviously launched there. They're a bit more close guarded with their credit policy information. Most of them will give you a product guide and kind of. But what we actually do is we sign NDAs with a lot of the lenders because we have some great relationships. I've been doing this for 14 years now, and in those NDAs we get copies of their more detailed credit policy, not just the product guide. We understand the ins and outs, and we do it for their sake. We don't want to be sending them deals that they can't say yes to. It's a waste of their time. And so with one of the fintech lenders that we had, at one point they came out and said to us that we had the highest submission to credit approval rate in the country, and we weren't their biggest broker. There's some that have been around a lot longer and specialize in that niche and that kind of thing. But they were like, how do we get more submissions from you? Because if anything, you're being too strict. And we would probably open up our appetite given how well they convert. So, there is a balance. Obviously, they want as many deals as they can look at, because at the moment, for submission to approval 90%, that probably tells them internally, when everyone else is submitting to approval at 50 or 60%, that they might be missing some opportunities to deal with us and our clients. So
yeah.
But that's the idea. The idea is more a traditional broker model relies on the broker and their skills, expertise, knowledge, how to get a deal approved. It's very much a shotgun approach, though. It's like spray and spray. These are the 3-4 lenders. Let me just talk to each one of them. And whereas our model is more like a sniper. Terrible analogy using guns, but it's the best way I can sort of get people to understand exactly. Like Loan Options is the sniper. It's like we go through the due diligence. The technology does a whole lot of things, and so we pick the lender. And when we pick that, there's a very high confidence level that that's the right lender.
Yeah.
So we don't stuff them around. And what that's enabled us to do is, deliver speed to the client. The fastest we've ever gotten a client funds from their initial inquiry to money in their account for a personal loan was 36 minutes, which is absolutely unheard of. Nobody in the industry has even come close to that. And so, for that to occur, there's a few things that need to happen. One is you need to have great technology to onboard the client, which is what we do, that 5-minute application process. You then also need to have relationships with lenders that can approve really fast. And in this case, the lender approved it in about 7 minutes or something. It was crazy. And then lenders that have the digital capability, like digital signatures and stuff for the loan contracts. But you also need a team that has confidence in the tech to pick the right lender, and that's what happened. The client applied, it suggested a lender, and the lender was perfectly selected by the client selected it, and our broker confirmed that was the best case scenario for them. And they were a registered nurse on their lunch break, and before the lunch break was over, they had the money in their account. So the tech, that sharpshooter style, definitely does exactly as advertised. The downside to it is obviously not everybody wants to engage online. Some people just want to pick up the phone and talk, but we have that capability too. Just because we have amazing tech doesn't mean we don't have amazing brokers that sit behind that tech. And I think that's the part that I think most people are surprised by, because it's like tech, AI, all this stuff, and then they actually talk to someone who's an amazing broker that actually just makes the whole process so easy for them. I think that's the part that I think most people are surprised by.
I imagine a lot of people just look at technology in general and think that it's going to take over the world, really. But I'm a big believer that it just enables brokers to do business better.
Yeah.
And that's a great example of that. What I was going to ask you was specifically, obviously you can do everything you can on your side to speed up the process. When someone comes onto your website, they get a good feel as to whether they're going to get approved or not. And which bank that might be and what their options are. But obviously on the bank's side, on the lender's side, there's still someone physically who's approving it, right? So at what point do you think lenders will start getting to a point where they've got some technology where it can automatically go through and get approved straight away?
Yeah, and I think that's going to be a slow process because, they do need to implement their own technology and auto decisioning capabilities and then track and monitor them for 6, 12, 18, 24 months to see if the auto decisioning is causing an increase in losses or arrears and things like that. But we're already talking to a couple of lenders about connecting directly to their auto decisioning engine, to their credit decisioning engine, manual and auto decisioning. And so what that will enable us to do is actually provide an approval response back to the client in real time while they're filling in their details on our website. And that could be a formal approval where we're saying, yep, you're applying for 80, we've assessed all of your documents and we think that we can lend you 80,000. But then, it could also be, actually we're only willing to offer 60. They can look at other options and continue down the process if they want more than that. So that's fine. I think that's going to come faster for commercial applications, unregulated business. I think that makes sense. Obviously, from a consumer standpoint, we have a credit license and responsible lending obligation. So we still do need to have the human looking over the deal. I'll say that, at a certain point in time, that will be the bottleneck, but it's not bad that it's the bottleneck in the process, because we do obviously want to make sure, even as good as AI is, even as good as our technology is, we want to make sure that our humans are giving the green tick as well. They're the licensed, accredited, trained brokers. They know what to look for. We never want to put a client in a situation, and we wouldn't compromise our record there. We would never want to put a client in a situation where maybe they're going to be worse off because no human looked at it and found something super obvious that the AI has missed. So, that for me, that's important. But if that's the only bottleneck and that's a safeguard, we'll see it as a safeguard rather than a bottleneck.
So you've definitely got brokers in your business, because it's not just a business of technology where it automatically goes through, right? You've definitely got experienced brokers who are reviewing each deal. Is that how it works from a process perspective? Yeah,
absolutely. And so we've optimized, to a certain degree, and there's still, a lot more work to do. But essentially where we are now, for an asset finance broker, a really good one would settle, around 25 loans a month. The top 1% would probably settle 30. Top 0.01% might settle 35 or so. One of our brokers settled 54 loans in a month, and it's not uncommon for our top brokers to settle 30 plus, 40 even. So that, but settling 54 loans in a single month with the amount of work involved in that, that's not easy. And, it's basically, almost, if you look at the business days, it's nearly 3 loans settling per business day. Given a lot of the banks aren't open over the weekend. So it's a significant amount, and we will continue to sort of optimize that, but it's there's still humans. It means that a business our size, we've got about 35 people. Only one of them is a broker support member. If you go to other businesses that have 20 plus brokers in our team, and that's about the split, there's around 20 brokers, the rest are other functions in the business. The product team is, around 8 people, software engineers, CTO, all that kind of stuff, policy analysts. But if you look at a business that has about 20 brokers, generally speaking, a lot of businesses would have 1 broker support staff member per 2, maybe per 3 brokers. So it would be quite typical to see a broking team that size having, call it 6 or more. Could be up to 10 or more broker support staff, and we just have 1. So,
and is that primarily to help out with fulfillment generally? Yeah. And so
admin, processing, data
that's
entry.
The amount of business that's the amount of work that you're talking about to get a deal through, right?
Yeah.
And so obviously we've spoken a lot about client acquisition or front end, how it gets demonstrated or put to a client, but how does the technology then impact with or assist with fulfillment with the client as well?
A lot of it's integrations to do, serviceability checks, calculations to determine suitability, and then APIs to connect directly to lenders to submit directly to them instead of having to rekey the information in the lender system. So that's a large portion of it. The lender selection, like I said, that credit decisioning engine works. There's a broker side to that as well that's a little bit more advanced than what the customer can access on the website. Quite a bit more advanced, but it's necessary because the brokers obviously have more levers they can pull and understand the lender's credit criteria and the client's credit situation in a bit more depth. And so it's always that balance of like, how much do you put in front of the customer before you start confusing them? And we think we've got the balance right at the moment. Maybe 1 or 2 more tweaks I'd love to do, but yeah.
And take us through, I guess, a little bit of the process, because I think a lot of the people listening, they hear a great success story and they think, oh, wow, built some technology overnight, you've got to 30 people, but I highly doubt that was the case. I suspect there would have been trials and tribulations within that. And I imagine at some point too, the lenders didn't automatically say, yeah, we'll give you some connectivity or whatever it might be. And so, were there ever situations where you had to manually input things and it felt like you were doubling your workload to some degree just to get it to a point where you could then, okay, cool, we've proved the product, here's our MVP, now we can actually start rolling it out?
Yeah, 100%. Like, our business has only ever known adversity. Like, I started it in COVID, right? And then I want you to think about it. Back then, like, primarily we were secured loans. Like, we were doing lots of cars, lots of trucks, lots of, assets that we could use as security. And supply chain issues happened, right? So first we had COVID. We dealt with COVID. COVID then caused supply chain issues. Supply chain issues meant that we had lots of approvals sitting in the pipeline, but no cars. And our business model is like, we don't charge the customer, right? It's like commission is paid to us, and any fees that are paid to us, they're paid on settlement. So if the cars are 6, 12, 18 months away in some cases, that means we're not getting paid for that. And so we had to pivot the business, and we had to start doing a lot of unsecured lending as well. So personal loans, unsecured business lending, so that we could bank, there was no supply chain issue, right? We could settle the loan, get paid for it, and go help the client. And so after supply chain issues, then of course, what did we have? We had, round 2 of COVID, right? Where, the lockdowns were a bit more severe and everything was sort of locked down for a while. After that, we had rising interest rates and inflation and, the cost of living crisis. And there's so many other examples, customers experience floods and fires. This is all stuff that's happened since we started the business. So, it is easy to look at it and go, oh, wow, they've done some amazing things. But we've got the technology wrong before, and we've had to start certain projects over again, or, I can't tell you how many times we've signed agreements to do partnerships, and they don't meet their end of what's meant to be brought to the partnership. And, that leaves you in a really sticky position because you've paid money, you've done all these things, you've invested your time, energy, efforts. We've had, for every 1 win, we've probably had somewhere between 5 and 10 losses. And that's not an exaggeration. We had a lending product of our own that was meant to go live, and then all kinds of, broken promises, and it's probably needs a whole another a podcast for itself, because I'm telling you, that's not an exaggeration. I would say definitely closer to 10 or more per 1 win. So to get 1 decent win, 1 decent partnership, 1 decent technology breakthrough, we had to, burn through 5 or 10 at least. Yeah.
And out of interest, you mentioned having your own product. You haven't gotten to that point yet where you've established your own product again, or tried that again?
We think we add more value to the market the way we sit now. Our business model is totally unbiased, right? And I always want to preserve that. If customers go to a marketplace now, like a compare style marketplace, won't single them out, but there's already a couple of them that do that. They always have the top offer for the loan comparisons is like a sponsored offer, right? And the problem with that is that's not the best outcome for the client. There's 2 things that happen there that I don't like. I think is very sneaky. One is they're paying to play, which means that the client's just getting whoever's got the highest bid basically on that piece of real estate on the screen. The second thing is they advertise rates that have no intelligence behind them. So they just say rates from, and they'll put like a really, it's almost like
figure.
It's misleading, right? It's misleading because it says rates from, and it could be 5.6% or rates from 6 point something percent. But the hoops that the client needs to jump through to qualify for that, and it's such a tiny little box of customers that your credit score needs to be above X, and
right.
You need to be a property owner, you need to do blah, blah, blah. It's like, it's not really clearly articulated when they click on that offer. And then of course, those comparison sites, they take the client directly to that application form where they have to apply. As soon as they apply,
rely on the duration of the time that it takes, and then someone's already in there.
Well, they could, let's say, take some 10 minutes to fill out that application. That's being very generous to the online applications that these lenders have. They put a hit on their credit file. Their score now drops, which reduces their eligibility for good rates elsewhere. They then realize that it's not 5%, and that I actually only qualified for 7 or 8 or 9%, or that they got declined, so they obviously don't qualify for 5 point whatever percent. So then they go back to the comparison site, choose the second one on the list, which is another sponsored offer, or someone who's paying more than the person third on the list, and they keep going through this process. until they get an approval. But by then they've absolutely destroyed their credit file. And it takes 5 years for those inquiries to drop off. And so they have to fill out their information, they have to share their ID and the income documents all over again. So we solve that problem. A client come to our website, in less than 5 minutes they've applied with no impact to their credit score. It's a single application form that can push data into over 90 banks and lenders, but we have the unbiased approach. No one, like lenders offer us money all the time, we say no every single time. You cannot pay us, doesn't matter what the check size is, you cannot pay us to lift your result up the list. When they ask us how do they get higher up the list, we say make your product better. That's just as simple as it is. And so I like that. If we introduce our own lending product, two things happen, right? One is we're now competing against the lenders that are on our panel. I'm not saying we won't do this, but it's just looking at it objectively, it's not the highest priority. One is, we're competing with lenders that are really good to us. Number two is we aren't necessarily able to say that we're totally unbiased then, because we have, potentially a conflict. Now, we're still obligated to give the client the best product for their situation, but even the illusion or the perception of a conflict of interest is uneasy to me. So when we looked at a lending product, it was about solving a problem that wasn't currently solved by our lending panel. So sub $5,000, there's a lot of loan shark type lenders, right? And they're really expensive, and they're basically like a trap. They're called payday lenders. And so for me, our lending product was going to be sub $5,000, help people that are sort of in that lower socioeconomic class where, they get an expensive mechanical repair bill, keep them off the sort of, I'm not even going to give them the clout, but keep them off those payday lending, loan shark style arrangements. And it was going to be an interest-free product. They just pay a fee to access like an overdraft fee, basically. And so that side of it is really appealing to me, and that would probably be where we would focus our energy if we were to create our own loan product. It would be about picking the niches that aren't currently solved by existing lending panels. So that way it is value add to the customer. We can retain our unbiased, completely independent approach, but also still, help the client and, even add value to the lenders, because we already have relationships with multiple ASX listed companies where through their direct channel, if the client gets declined, they get sent through our technology and through our platform, and we find them a solution so that the client doesn't miss out, right? They're obviously applying for a loan because they need the money. That lender can't help them. They then come through an integration through our system, and our team facilitate them. And we've delivered amazing results from that. So if we have another product to that, we can obviously help even more customers.
And so a lot of it is asset finance specific, right? Why not mortgages? Or are you in that space now?
No. So I'll make a clear distinction here. We are a specialist business. We're not trying to be all things to all people. We are very good at these four main categories. Unsecured personal loans. So think home renovations, traveling, think debt consolidation, that kind of thing. Car loans, right? Motor vehicle loans. So even motorcycles, all that kind of stuff. Equipment finance, so any type of equipment, whether it's software and IT equipment or excavators, earth moving trucks, that kind of thing. And unsecured business lending, so businesses needing line of credit, working capital. They want to acquire another business because they're growing and they want to speed up the growth. Really good at those, and that's our specialty, right? If it's a type of loan that falls into that, we're really good at boats as well. So we recently signed a partnership with boat sales and bike sales, part of the car sales group, and so we're excited by that. That's like our core competency. We partner with, and our technology is white label, and we give our technology for free to mortgage brokers so that they can enable their clients to get a really good asset finance deal, which is like a value add. So there's a stat that says 70% of people who purchase a new house within 9 months also upgrade their car. So that's just like one stat, but like obviously a lot of those people who are buying houses and mortgaging property, they also own businesses and have other needs. For mortgage broking and asset finance broking are two separate classes. They're two separate accreditations. You still need the same kind of certificate or diploma, but you need different aggregators, you need different lending products. They're very different. So we're refraining from trying to be, a jack of all trades. Come to us for everything. If you want to finance this or like all the way up to X, Y, Z. We want to be really well known for what we're good at. And in the process, we've created a model that means that we don't need to be all things to all people. Like this white labeling of our technology to mortgage brokers, we give it to them for free, and we do a revenue share on all the loans that we help them settle, and we white label the process. Like our team can call and say, I'm from the asset finance division of ABC Mortgages. And it's our team that's supercharging and bolting on to their business. And we signed up over 900 mortgage brokers, over 2,000 partners with that white label solution. So that's going really well. We don't want to disrupt that and cause channel conflict by also doing mortgages. It just wouldn't make sense that mortgage brokers account for a large percentage of our revenue. Yeah. So if we step on their toes or bite the hand that feeds you, like it just wouldn't make sense.
No.
Secondary to that, now that we have these mortgage brokers, a lot of them ask us like, when are you going to build this tech for residential lending? Because like your tech's amazing, but obviously my core business is home lending. Like when are you going to build this for me, Julian? And so we just this year launched it, and so now we have a technology that's a software as a service product, like a subscription they can opt in for, and it's a 5-minute home loan application. So if you go on our website and you kind of test that out, if anyone wants to refinance their loan, now it won't be us providing the home loan. We'll connect you with one of our, one of the top mortgage brokers in the country that is on our panel, and we just try and share the love a little bit with the mortgage brokers who are sharing the love back to us with asset finance. But we do have a due diligence process to when we onboard mortgage brokers for us to send them leads to make sure they have all the relevant lending panels and things like that to give our clients a good experience. But that's the model we're going with as far as supporting that channel. We don't need to be a mortgage broker. We work with some of the best ones in the country already, and we've just built this technology that can enable a reciprocal relationship. So we don't do home loans. Client applies for a home loan via our website. We'll say, hey, great, thank you for that. We're going to connect you with Victor because he's an SMSF expert, or whatever the type of loan, or this one person's a commercial property. Well, I'm going to connect you with a commercial property expert, and so we think that we can do a great job and connect them with the right people.
Yeah, it's interesting you say that, and we could probably do a whole other podcast on specialization versus generalization. We've had, obviously we're in the business of insurance, business insurance that is, and often the conversation comes up is, hey, finance, and then it's kind of like, well, if you're partnering with people who are giving you insurance solutions post finance, then why would you cut ties with that or ruin that relationship? And I think that's probably a real sound approach to just focus on one particular area versus being all things to all people, I guess, in that sense. Generally speaking, though, talking about moving away from loan options a little bit, and I guess general business world, what are some of the key issues that you think needs changing in today's business world?
That's a great one. I think at the moment businesses are being hounded by the ATO, and we're seeing it. A lot of small businesses are coming to us at the moment for refinancing their tax debt, because as of July 1st, the ATO has changed the rules, and any debts that you have as a business owner have outstanding to the ATO, the general interest charges are no longer tax deductible. So that's forcing business owners to have to scramble and try and refinance their debt, but they're being aggressively pursued, and in a lot of cases, their businesses are being wound up or they're being issued with directors' penalty notices. I just, if anyone is listening to this from the ATO, I would ask that they exercise some restraint. Small business owners over the last 5 years, with everything I just explained, have had the worst possible time. It has been so hard. Super has just gone up. Whole range of other things that come in that are minimum wage increases. Now, I'm not against people earning a living, right? That's the thing. But when you mandate it, the businesses that hurt the most are usually the ones that do have, let's say, lower skilled roles, right? It doesn't matter if you're in the hospitality industry or whatever. It doesn't take somebody with 160 IQ to take a coffee or cafe order and then, pass it to the kitchen. Like these are usually entry-level jobs, and the people who the effect that actually occurs is business owners offer less opportunities to the young generation because they have a fixed amount that they can spend on wages and staff coverage. And so when you increase the wage, they actually have to reduce people's hours. And so it's actually having the opposite effect, but it is hurting business owners. So among all those things, I think they just need to leave small business owners alone a little bit. They've had a bit of a tough run, and I would love to see some common sense approach to the way they collect tax debt and be flexible around it. It would help a lot of people I know.
Are you seeing quite a few business owners come to? Well, you've already said you have had a few business owners coming to you looking to refinance, but are you seeing situations more and more where there are businesses who can't refinance that debt and having to fold?
Yeah, and so one example of that is, sometimes that we can, put them in touch with someone who can help them do the small business restructure, the SBR scheme. But, they've been pushed into a corner, and, you can argue what you want and say it's their fault for not managing their money properly and all this kind of stuff, but it hasn't been easy. I know really strong operator business owners that are struggling, and it's, everything is so expensive. Their cost of their goods have gone up. Their customers expect them to keep the same prices. Like it's really tricky. And so they can't actually enter an SBR scheme because they have some outstanding super or something like that. And then so, some lenders aren't being that flexible with people who are, trying to enter an SBR or have entered an SBR restructure. So I think, in some situations it's fairly late, but there is always a solution, right? We have lenders that can help, and they might not be that cheap, but what we do, and we've done this multiple times, is we put them in a lending solution that can allow them to pay back the super. Then they can enter the SBR. It's like a phased approach. They do the SBR, they get back on track, they negotiate with all the creditors, and then obviously once the business is back on track and they've got their head above water, we refinance the debt into something way more competitive and get them out of that. But sometimes it's like a 5 or 6 phase approach.
Yeah.
And, probably wouldn't be there if, times weren't this tough.
Yeah. And it's funny, I heard something a little bit when you said, a cafe, it doesn't take someone 160 IQ to pass on a message. They're all things that technology can solve in the future, right? And a technologist like yourself, do you see that as an opportunity that you want to get involved in, or is that something that you're just like, look, that's just not my space, but you guys should really think about using technology?
Well, like even the solutions, and they're not even that crazy to implement. There's already great companies that do that, like the QR codes and stuff. Like, don't get me wrong, I'd much rather take my order. When I go into a McDonald's and my kids want Maccas every now and again, and they have the machines that you want to order. No, I just want to order. I want to talk to somebody and just take my order, because by the time I finish tapping that screen 50,000 times, you get annoyed, you get frustrated, because the solution is just saying, can I have a kid's 2 6-nugget Happy Meals or something. Like the human can do that much faster than these user interfaces, right? Now, those interfaces will get better over time and those kinds of things, but even like the QR codes at cafes, right? Like if that solution works and I get my food order right and it doesn't take me that long to order and look through the menu, then I'm happy to use them. But would I go and build a whole bunch of solutions for an industry that I'm not an expert in? Probably not. I think one thing that's made me reach this sort of level of growth in the business is staying focused. And it's very easy to get, because I know that there's so many things that I could do to solve problems for these, other industries. But, one thing at a time. When I feel like I've hit every milestone we've set out to hit with loan options, and we are delivering a huge amount of value to customers and lenders, then when all is said and done, then I might start looking elsewhere. But that's it for me.
And we'll touch on your vision in a second, but what's a key business risk that you see in your business and or your client's business that you see needs handling?
Cybersecurity. You know what's crazy? People are almost becoming numb to it, Like Qantas, Optus, like all these companies. Like the most recent one was Qantas. I can say this. We had, obviously we've booked, we travel a lot for work, so we mostly book Virgin, but every now and again we got to fly with Qantas. And our credit cards and information are in there. One of our staff members' cards were in there for a personal trip they booked. And so she had her card breached, and people were starting to order, and a whole bunch of our team members started getting all these two-factor authentication code requests to their phone, and then we found out about Qantas, hack, and they sent communications out saying that none of the credit card information was leaked and all this kind of stuff. But I know that's crap, because multiple people have had their cards breached coincidentally right after the breach. So cybersecurity is something that all business owners should be really worried about. Yeah, so I definitely think cybersecurity is the number one risk business owners should be concerned about. Whilst customers are becoming a little bit desensitized to losing their data, it is about trust and, potentially putting your customers in harm's way with, sort of people who have less than good intentions. So we've gone through the process to get our business, ISO 27001 certified, and we do penetration testing because, of course, we're asking clients to provide really sensitive information, right? But even if you're like, the amount of times I've gone into a business and they've got customer information just written on almost like a guest entry book, and it's just name, number, email address, or whatever. But you definitely shouldn't be using that. There's so many free services. Use a Google Sheet. Like, there's so many free services that are like a lock behind authentication that I definitely think business owners should make sure, just some free things that they can do is make sure that two-factor authentication is mandatory on all devices. Make sure that you have all the hard drives encrypted, through the settings of, a modern Windows or modern Mac, you can encrypt them. And that way, if somebody loses a laptop, they obviously can't get into the laptop because they need the password. But if the hard drive's not encrypted, they can actually open the laptop, get the hard drive out, put it in another device, and access the information. So make sure that, those are just free things that you can do. I think you can also provide some training to your team about, what suspicious emails are coming through, and, how to detect a phishing email from a real one, the types of things. Like, I remember we had an intern, and, he hadn't completed, it was like one of his first days, and he hadn't completed our cybersecurity training yet. And he got an email saying, it was appearing to be from me, saying that I need him to go and purchase Steam gift cards. And so poor bloke went and bought Steam gift cards. And anyway, we gave him the money for it and said, you absolute doofus. But, that's why the training is there. The training is there to like literally show people, like, this is what they will do to you. Trust me, I don't need you to buy me Steam gift cards. I don't need you to lend me money. I'm never going to ask you to do that kind of thing. But they're getting more and more sophisticated, because for them to know his email existed, they would have been scraping LinkedIn profile data, and he would have said on LinkedIn he started an internship at Loan Options. Someone's guessed his email, started and looked at who the CEO is, and so that kind of social engineering aspect is really, really scary.
And we're in this space as well from a cyber insurance perspective, right? And we see them following the, I guess, calendars of a CEO, right? When's the CEO going to be on that ski trip, for example, out of reception, and then send an email from that CEO's email, whether it's a business email compromised, they're already in the email, or whether they've bought a domain that changes the font a little bit slightly. It might look exactly like a LoanOptions.ai, but the font's slightly different on the I at the end.
Yeah.
We've seen some pretty crazy things. To the tips that you mentioned, I'll also add, with the multi-factor authentication, definitely not making it multi-factor to a text message, but using an authenticator app. I think it's funny how things change so quickly, right? I feel like in businesses that we talk to, not every business is enabling their multi-factor authentication as a start to text message requirements. And we're already saying, actually, when you do enable MFA, make that to an authenticator versus a text message. So,
and the reason for that is there is people can port. There's like a hack where someone can call your telco provider, and some telco providers don't allow this, but you can basically, if they know your mother's maiden name and your date of birth and a few other things, they can actually port your mobile phone number to their SIM card and receive the text to then get into your account. And that same thing happened to my father-in-law, actually. So it can happen. And if you are not sure if your telco provider enables people to port your phone like that, you can set up port locking as well. So, basically you have a passcode that's like a secret code, but if you're someone who chooses really lame, easy to guess passwords or passcodes, that's something that you need to be very careful of. Where possible, use passkeys, use long passwords that have unique characters and things like that. It increases all those things are very important, and they sound stupid, but they actually could save your entire business. Because if small business owners maybe don't know this, but you can actually be held personally liable these days from not taking reasonable steps to protect your customers' information.
Yeah, we recently did a podcast on cyber insurance specifically, so we'll refer to that podcast if you like. But let's finish with the vision. I want to know the vision for Julian as it is, and Loan Options. What does it look like in 5-10 years time?
So it hasn't really changed. When we first started the business, the vision was to make applying for a loan as easy as checking out in an e-commerce store. So when you think about what's a great e-commerce experience, maybe say the Iconic as an example. Go on, look at, choose your colors, choose your size, and then you can check out, and you've got a few different options to check out with, right? And so that process goes really smoothly. You're probably on the website for 3 minutes if you know what you were looking for. We want to make applying for a loan as fast, so a slick process, easy, in terms of keeping all the information at their fingertips and not overloading them, and transparent as checking out in an e-commerce store. So an e-commerce store, you see the shirt, it tells you the price, you know what you're up for, it calculates the shipping, there's your total figure, you're happy with that, proceed, yes. In loans, it wasn't that way, and so we feel like we're the most transparent by far now, because in real time they're seeing not just the rates but also the fees and turnaround times and everything else that's relevant to that loan product. But so that hasn't really changed, and we're sort of on that journey. We're trying to get it from 5 minutes down to 3 minutes, trying to make it even better than it is now before we can say, okay, well, we've achieved that vision. And then it's just about how do we distribute this to more people. So initially it was to make applying for a loan, and it was specific to Australia. We then removed that word, and now we're across Australia and New Zealand, and then it's further international expansion. So I was over in the States and the UAE earlier this year in May and April, May, and that was about exploring those markets as opportunities for our technology to be distributed and used, and so that's kind of where we think the next 24-36 months of the business looks like. We have that new home loan product, the 5-minute home loan application. So we're going to continue to spend the next 12 months before we go overseas distributing that product and getting it in the hands of as many mortgage brokers as we possibly can, through partnerships and otherwise. And that's it. The ultimate goal is to create these sort of partnerships that we can help as many people as possible, save as much money as possible, and just change the way that people refer to applying for a loan. It's always been a really stressful process. It's always been a daunting task. If we can make the process enjoyable for people, then I think we're going to see a huge uplift in people prepared to use those facilities. You shouldn't need to have a finance degree in order to get a good deal, right? Or know somebody on the inside. That shouldn't be the case. It should just be use a tool like ours, put in your priorities, it will match you with the right lender, and make the process super easy. So,
and out of interest, do you foresee the vision to be where the broker won't necessarily be required as much? Do you think the technology can provide some advice around which option to choose?
Yeah, and it already does, right? So definitely there'll be less and less requirement for broker intervention. Obviously, we still have responsible lending obligations, so there's still some element of the regulatory environment needing to change before you don't need a broker at all. But the technology is not quite there yet where you don't need a broker at all. You still need a broker. And we're very pro brokers. We think that having somebody who's an expert look over your file and check over the offer that has been presented is a really good safeguard. What I will say though is that probably where I see brokers adding value in the future is on those edge cases. So if you've got a really complicated loan scenario or a really crazy edge case, then I think that's where brokers will add value. So 80% of the vanilla deals will be handled by an AI or automation and technology just in general, any of those three. And then the edge cases, the really super difficult, hard to come by scenarios that maybe AI is not necessarily going to be good enough to handle, will be handled by a skilled, senior, experienced professional that will find a solution.
Yeah, perfect. I was going to wrap it up there anyway. So Julian, thank you for coming on the show. It's been a pleasure to chat to you. And also a pleasure to see you develop over the years, right? So it's been 5 years or so since you and I met through Cub. And it's been great to see Loan Options grow and you develop. So
thank you very much.
Thanks for coming on the show.
Appreciate it.
Socius, thank you for joining us today. Please hit the subscribe button if you've enjoyed this episode. And if you'd like to be part of the Socius community, follow us on Instagram, Facebook, and LinkedIn to stay in touch. Cheers.